Today's episode of the Watson Weekly Podcast is sponsored by Miracle, the catalyst of commerce. We all know that e-commerce is changing at breakneck speed, but if you're still playing by the rules of retail's past, you're leaving money on the table, and a lot of it. Miracle empowers 450 retailers to successfully flip the script and transform their businesses by creating a flywheel of AI-powered marketplace and retail media solutions. What's stopping you from joining this retail revolution? It's March 10th, 2025, and this is the Watson Weekly, your essential e-commerce digest. Today on our show, Target 2024 earnings shows company falling behind. When will merchants stop treating data as a project? Commercetools layoffs throws into question IPO plans. And has Shopify Enterprise turned a corner? And finally, the Investor Minute, which contains 5 items this week from the world of venture capital, acquisitions, and IPOs. But first, in our shopping cart full of news, Target 2024 earnings shows company falling behind. Target's earnings were better than I expected overall, but the growth was still behind their peers. In contrast to huge operating income growth at Walmart and Amazon, Target's operating income declined year over year. Also, asking for a friend, where the hell is the Target CMO? Waiting for a hire there. A few Q4 highlights illustrate the challenge Target is up against. Comparable sales growth of 1.5% across digital and physical, e-commerce growth of 8.7%, and the operating income declined 24%. Compare these stats to Walmart in Q4, who had comp sales growth of 4.6%, e-commerce growth of 20%, and operating income growth of 8.3%. Essentially, Target is losing more money year over year and is growing slower than its largest peers, which is not a recipe for breakout success. If this is a Target magic, then the musician perhaps has lost his magic hat as well as any rabbits to pull out of it. Still, someone at the company must have heard me because they announced that Target Plus Marketplace was a key priority, which is planned to grow from $1 billion to $5 billion in revenue by 2030. Target's ad business also plans to double by 2030 to $4 billion from its current $2 billion. How about tariffs? The company explains this is contributing to consumer uncertainty, and this is leading to meaningful profit pressure in the first quarter of the year. This could be a warning sign to other retailers, especially those without as much buying power as Target. Our second story. When will merchants stop treating data as a project? I speak with a lot of companies on a day-to-day basis, and one of the most frustrating elements I see in the execution plans of large enterprises is their data strategy. It still seems to me that I see so many technologists and system integrators and even merchant teams speaking about composability. However, in my opinion, it seems like large retailers need less composability and actually more connectivity. Many focus on what solutions they need to compose together and very little attention to their workflow. Where data starts, how it combines and flows through these systems, and are these systems connected together? Usually the places where Excel lives, those are the breakdowns. Stop me if you've heard this before. The systems that you should be using for planning and analysis are not connected to this data you need, or the data appears but it's too late, or the data is at the wrong level of aggregation with questionable accuracy and no way to remove exceptions or anomalies which exist in everyone's data. The system integrators are helping you process transactions, but that's usually the bare minimum. The data you need to analyze and make decisions about the business are usually at another level of difficulty. Meanwhile, your data analysts, if indeed you have not fired them all, don't know the business well enough to deliver the right data to the business owners. I find the most common problem here is quite simple. Data is treated as a one-time project and not a continuous improvement process. As a result, once the project is over, the business teams are left to fend for themselves. Data is like your child as they grow up. As you get more experience, you start asking more complex questions. If there's not a data team there to support you improving the number of data sources, their reliability, and how they're used, then you're out of luck. This generally means analysts embedded within the business teams there to help enable the improvement needed to get the business where it needs to go. Our third story. Commercetools layoffs throws into question IPO plans. It's never fun speaking about layoffs, but this is part of what's going on in the commerce world as well. And I'm not an insider anywhere, just someone who tries to pay attention. What happened? This was reported by TechCrunch according to a verified internal memo. Commercetools laid off about 10% of its staff. They also restructured their management team, including the partners of the CFO and the chief revenue officer. And marketing was realigned to focus on enterprise. The CEO also gave a few choice words, which hard to say if they were taken out of context in the article. Quote, "We had really ambitious goals which had not reset to reflect the macroeconomic uncertainty," and cited question marks over how tariffs would play out as another factor impacting e-commerce companies and the knock-on effect that has on suppliers like Commercetools. In truth, I don't love these words from the CEO, even a new CEO who likely had not much responsibility himself for the past performance. But of course, as CEO, the buck stops here, and these words pass the buck somewhere down the street. How about this instead? We aren't growing fast enough, and some of our expansion areas into new markets haven't panned out. Instead, we are reoriented towards our strengths, which he did say some of this, but the reason why the performance didn't match the expectations was the part I didn't love. My read on the situation is pretty clear. There will be no IPO in the next couple of years unless something significant changes. The CFO who came on over a year ago and was widely believed to have done so in order to help take the company public, now there's no CFO at all at the company. Next, Commercetools' mid-market activities, which to my read and likely the company's read have not been extremely effective, are likely ceasing. Commercetools is viewed in an enterprise light, and the company does not have the ability to change that perception and reality anytime soon. I do still expect further expansion beyond retail into the other verticals they have already been targeting. Employee attrition has also happened. In the past year or so, Shopify has notably picked up some Commercetools sales executives as it continues to move up market. And it goes without saying that my friend Kelly Gage, in many ways one of the most visible public faces of Commercetools, departed early this year. And it's also probably not just employee attrition. What about customers too? This is speculation, but speaking about headless for a moment, some retailers during COVID got caught up in an infrastructure they could not easily support. Not that it's totally unsupportable in practice, but it's also easy to screw up by the wrong implementer. And some retailers, as a result, have migrated back away from it. I would not be surprised if some of the growth issues have an attrition element to them as well. All told, no IPO soon. And until growth rebounds, maybe never. And so the IPO market turns, folks. ShipBob and Klarna are probably on deck. Bueller, when are they coming? And our last story. Has Shopify Enterprise turned a corner? Shopify CFO Jeff Hoffmeister recently sat down at Morgan Stanley Investor Day to speak about a range of topics, but inevitably the talk turned to enterprise. Here are a few tidbits I took out of the talk. First, Shopify seems past its initial investment up the enterprise learning curve. The CFO revealed that it takes about 9 months to close an enterprise deal and about 9 months to implement software. So that's 18 months. When you consider that Bobby Morrison was hired about 30 months ago, today in August of 2022, let's subtract about 6 months from that to allow for the fact that he's building a team from scratch. We're really only talking about a 24-month period the company has been in the market at all. When you compare that to 18 months to launch and sign a customer from scratch, it appears to me that Shopify is kind of right on target in its ability to onboard new enterprise merchants. Second, the Morgan Stanley questioner pointed out that most of Shopify's legacy competition like Salesforce and Adobe are long in the tooth, and that Shopify is anything but that. This certainly provides a tailwind to Shopify's business. Finally, the question is going to be very simple going forward. Can Shopify Enterprise grow fast enough to justify continued investment relative to other opportunities the company has? Shopify is quick to point out that B2B, point of sale, Europe, and other opportunities are growing much faster than Shopify's core business, which is itself growing twice as fast as the rate of e-commerce. Shopify is not revealing how fast enterprise GMV is growing, and there may be some reason for that. The rest of the business is simply outpacing it. In fact, it's possible that Shopify Enterprise will forever be the least productive part of the Shopify growth machine. Is that a long-term liability for the enterprise team? It's that time, friends, for our Investor Minute. We have 5 items on the menu today. First, Blue Pool Capital acquires 12% in Golden Goose. Blue Pool Capital, backed by Alibaba founder Joe Tsai, has acquired a 12% minority stake in luxury Italian sneaker and apparel brand Golden Goose for an undisclosed amount. Premier will retain a majority shareholding in Golden Goose. Blue Pool Capital will help Golden Goose grow in the Asia-Pacific market and provide expertise in the sports, entertainment, and consumer industries. Golden Goose postponed its initial public offering in Milan in June 2024, and this deal was negotiated and agreed upon shortly after its IPO postponement. Second, Tusk Logistics secures $2 million in seed funding to launch alternative carrier management platform. Tusk Logistics, a nationwide network of regional parcel carriers, has announced that it's raised $2 million in seed funding and has unveiled its new operations platform. Tusk Logistics offers shippers access to improved margins without the need for national carriers such as UPS, USPS, and FedEx. Aggregating a sector dominated by fragmentation and inefficiencies enables shippers to access a new, cost-effective solution without the manual overhead of working with multiple regional carriers. Third, MarketLeap raises $8 million Series A round. MarketLeap, an AI-driven platform that helps direct-to-consumer brands sell on global marketplaces, has raised $8 million in Series A funding that will be used to hire talent, invest in its platform, and further expand in the United States. Interesting to note that the founding team are ex-Amazon employees who saw sellers' challenges when going to a new international market. Helping D2C businesses go international via marketplaces sounds contrarian. Fourth, Tapestry to sell Stuart Weitzman to Solaris for $105 million in cash. Tapestry, a multinational fashion platform, announced that it will sell Stuart Weitzman footwear brand to Solaris, a portfolio of consumer footwear brands, for $105 million. Selling Stuart Weitzman enables Tapestry to focus on growth for Coach while reinvigorating sales at Kate Spade after Stuart Weitzman struggled due to weak luxury spending in North America and China. Stuart Weitzman will become the lead label in the Solaris portfolio and accelerate sales. Is this the fallout from the failed Capri and Tapestry merger? And finally, Steve Madden to acquire Kurt Geiger for $360 million. Steve Madden has to acquire Kurt Geiger London from a group led by private equity firm Cinven for £289 million. The transaction will be funded by committed debt financing and cash on hand, and it will immediately add capital to Steve Madden's bottom line. And it also aligns with the initiatives expanding in international markets, accessories across categories, and complementary direct-to-consumer channels. The transaction will be funded by committed debt financing and cash on hand, and it will immediately add capital to Steve Madden's bottom line, and it aligns with initiatives in expanding in international market, accessories, and complementary direct-to-consumer channels. Did you know that RMW Commerce has another podcast? Check out the Watson Weekend for an unfiltered and lively e-commerce chat each week with me, Rick Watson, my co-host Jess Liseski, and an array of interesting guests and topics, all focused on e-commerce. You can find the Watson Weekend by searching for it on iTunes, Spotify, or YouTube. That's all for this week. Till next time, Watsonians. Hi, I'm Rick Watson, CEO and founder of RMW Commerce Consulting and host of the Watson Weekly podcast, your essential e-commerce digest. Our production partner for the series is Podcast on the Fly. This podcast is produced by RMW Commerce. To hear new episodes of the show every Monday morning, subscribe now at rmwcommerce.com/Watson Weekly and wherever you get your podcasts.